Before you put your money into an investment, there is one question you should be able to answer. Why am I buying this? Not because someone on social media said it's going up. Not because the stock is trending. Not because your friend made money from it. And definitely not because the price dropped 50% and suddenly looks cheap. The problem is that when beginners try to research an investment, they often get buried under information, revenue, earnings, debt, margins, PE ratio, cash flow, analyst ratings, news, charts, and about 50 other numbers. So today we're going to simplify the entire process. I'll show you a 7-step investment research framework you can use before putting money into an individual company or other investment. And the goal isn't to predict the future. It's to make a better decision with the information you have today. Understand what you're actually buying. The first step is surprisingly simple. Understand the investment. If you cannot explain what the company does in plain English, you're probably not ready to invest in it. Imagine someone asks, "What does this company actually sell?" And your answer is, well, they're involved in AI, cloud computing, digital infrastructure, and the next generation of technology. That's not an explanation. Try again. Who pays the company? What are they paying for? Why do customers choose this company instead of competitors? And where does the company's money actually come from? Here's a simple test. Imagine you have 30 seconds to explain the business to a 12-year-old. Could you do it? For example, a company sells software that businesses pay for every month. That's understandable? Then you can go deeper. How many customers? How much does each customer pay? Are customers staying? Is the company making more money from existing customers? This matters because a stock ticker isn't a business. You're buying a claim on a business. So before looking at the stock chart, understand the machine behind the stock. Step 2, find out how the company makes money. Now let's follow the money. There are 3 questions. Number 1, how does the company generate revenue? Number 2, is that revenue growing? Number 3, does the company keep enough of that revenue after paying its expenses? Let's say Company A generates $1 billion in revenue. Sounds impressive. But if it spends $1.1 billion to generate that revenue, that's a very different story. This is where beginners sometimes focus too heavily on revenue. Revenue is important, but revenue isn't the same thing as profit, and profit isn't always the same thing as cash. That's why I want you to look at the company's cash flow too. A company can report accounting profits while still having serious cash problems. So don't just ask, is the company growing? Ask, is the company growing in a way that actually creates economic value? Same revenue, completely different business. Step 3, check the financial health. Now we need to answer a question investors sometimes overlook. What happens if things don't go according to plan? This is where the balance sheet becomes important. You don't need to become an accountant. Start with 3 things: cash, debt, and the company's ability to generate cash. Imagine 2 companies. Company A has $10 billion in debt and $1 billion in cash. Company B has $2 billion in debt and $8 billion in cash. Even if both companies are growing, they don't have the same financial flexibility. Debt isn't automatically bad. Companies can use debt to expand, acquire businesses, build factories, or invest in growth. The question is, can the business comfortably handle that debt? Then look at whether the company's cash generation is improving or deteriorating. A strong business should ideally have financial room to survive difficult periods. And here's an important research habit. Don't only look at the latest quarter. Look at several years. If you are getting value from this video, give it a thumbs up, like, share, and subscribe to my channel Let's continue. Step 4. Look for the company's competitive advantage. Now we get to one of the most important questions. Why might this company still be successful 5 or 10 years from now? Because a company can have great numbers today and still have a terrible future. Ask what makes this business difficult to compete with. Maybe it has a powerful brand. Maybe customers face high switching costs. Maybe it has a huge network of users. Maybe it has proprietary technology. Maybe it has a cost advantage. Maybe it has distribution that competitors can't easily replicate. Or maybe it has something else. The key question is, what prevents another company from copying the opportunity? Let's say a restaurant makes amazing food. That's great. But if someone can open a restaurant next door and copy the concept tomorrow, the advantage may not be very strong. Now imagine a business with millions of customers, a trusted brand, huge distribution, and years of accumulated data. That's a different situation. You don't need to predict which company will dominate the future. You need to understand, why does this company have a chance of maintaining its position? Step 5. Don't ignore management. Here's another part of investment research that doesn't always get enough attention. Management. The people running the company decide what happens to the money the business generates. Do they reinvest it, acquire other companies, pay dividends, buy back shares, issue new shares, take on more debt? And most importantly, do their actions match what they tell investors? Don't just read what management says. Look at what they actually do. If management constantly talks about creating shareholder value, but repeatedly destroys value through poor acquisitions or excessive dilution, that's worth investigating. You should also ask, does management communicate honestly when things go wrong? Do they explain mistakes? Do they provide realistic expectations? And are their incentives aligned with long-term shareholders? You don't have to decide whether the CEO is a good person. You're researching whether the management team appears capable of allocating capital responsibly. Step 6. Check the price. Now here's where investment research gets really interesting. You can find an excellent company with excellent products, excellent management, strong growth, and still make a bad investment. Why? You paid too much. A great business isn't automatically a great stock at every price. Imagine someone offers you a $1 million house. You might say, that's expensive. But if the exact same house is offered for $100,000, your reaction changes. The asset didn't change. The price did. That's why you need to assume valuation. One commonly discussed measure is the PE ratio, which compares a company's share price with its earnings. But don't stop there. Different industries deserve different comparisons. You can also examine things like price to sales, price to free cash flow, earnings growth, margins, and the company's valuation compared with its own history and relevant competitors. The important question isn't, is this stock cheap? It's, is the current price reasonable compared with what I believe the business can produce in the future? And that's a much harder question. Which brings us to something even more important. Step 7. Build the bear case before you buy. This is the step I want you to add to your research process. Before buying an investment, try to prove yourself wrong. Because when you really like an investment, your brain naturally starts collecting evidence that supports your decision. That's confirmation bias. So instead of asking only, why should I buy this? Ask, what could make this investment fail? Maybe a competitor is gaining market share. Maybe profit margins are falling. Maybe the company depends too heavily on one product. Maybe set is becoming a problem. Maybe growth is slowing. Maybe the valuation already assumes years of incredible success. Or maybe the entire industry is changing. Write down your three biggest risks. Then ask, what evidence would tell me that my investment thesis is wrong? That's powerful because now you're not just looking for reasons to buy, you're defining the conditions under which you would walk away. Use primary sources. There's one more research habit that can dramatically improve your process. Don't build your entire investment thesis from social media. Someone's TikTok or YouTube video can give you an idea, but an idea isn't research. Go closer to the source. Read the company's annual reports, quarterly reports, investor presentations, and regulatory filings where available. Look for the actual numbers. Look for risks. Look for changes in the business. And compare what the company said previously with what actually happened. This is one of the easiest ways to separate research from internet excitement. You don't have to read every page. Start with, what does the company do? How does it make money? What are the major risks? How is the business performing? What does management expect? And what could go wrong? The 10-minute investment research test. So let's turn everything into one simple checklist. Before investing in an individual company, ask one, can I explain what the business does? 2, do I understand how it makes money? 3, are revenue, profits, and cash flow moving in a healthy direction? 4, does the balance sheet look financially manageable? 5, what gives this company a competitive advantage? 6, do I trust management's capital allocation and communication? 7, is the valuation reasonable? 8, what are the 3 biggest risks? 9, what would prove my investment thesis wrong? 10, did I research the company itself instead of relying entirely on someone else's opinion? If you can't answer several of these questions, that's not necessarily a signal to buy or sell. It's a signal to do more research or simply move on. And that's completely okay. There are thousands of investments available. You don't have to own the one you research today. Here's the biggest lesson I want you to remember. Investing isn't a contest to find the next stock that goes up the fastest. It's about making decisions where you understand what you're buying, why you believe it has value, what you're paying for it, and what could cause you to be wrong. And sometimes after doing all that research, the smartest decision is, I'm not buying this. That's not failure. That's discipline because your goal isn't to make a decision on every investment. Your goal is to make better decisions with your money. And if you want a simple rule to remember, use this. Understand the business, check the numbers, question the price, find the risks, and always know what would prove you wrong. This video is for educational purposes only and isn't financial advice. Investing involves risk, and you can lose money. If this video helped you understand how to research an investment, subscribe to the Wealth Workshop for more simple, practical lessons about building wealth.